All right, let's talk about Spruce Power, ticker SPRU. Their latest earnings report just dropped, and it's a real head-scratcher. On one hand, you've got some fantastic-looking numbers, but on the other, the stock's reaction tells a totally different story. So we're going to dive in and try to figure out this disconnect.
And here it is, the central puzzle we need to solve. Spruce absolutely crushed it on revenue, up 48%. And their key profitability metric, operating EBITDA, was up a whopping 71%. I mean, those are blowout numbers. And yet the stock finished the day down 6%. It just doesn't add up, right? So what did the market see that the headlines missed? That's exactly what we're going to unpack.
So first things first, let's give credit where it's due. We've got to look at the actual operational performance because honestly, it was genuinely impressive. You can really see that management is firing on all cylinders here. Let's start with revenue, which came in at a cool $33.2 million. That's a 48% jump from last year. And where did all that new money come from? Well, it was almost entirely driven by the big portfolio of solar assets they bought from NJR Clean Energy Ventures. This shows you that their M&A strategy isn't just talk, it's directly pumping up that top line. Now this next number, this is the one management really wants you to pay attention to. $24.6 million in operating EBITDA. That is a massive 71% leap from a year ago. For a company that is laser-focused on generating cash, this is absolutely crucial. It shows that the profitability of their assets is scaling up, and it's scaling up fast. And here's the other side of that coin, aggressive, and I mean aggressive, cost control. Their operations and maintenance expenses, the cost of just keeping everything running, they were slashed by 52%. And look, this wasn't some fluke. This came from using new tech and just getting smarter about how they service their 85,000 solar systems. That right there is what you call operating leverage. And you can see here, this discipline wasn't just in one area. Their total core operating expenses fell by 19% overall. This is proof that cost-cutting is baked into their DNA right now. It's a core part of their entire playbook. They are squeezing every last drop of profit out of their assets. So you've got strong growth and you've got falling costs. What's the grand plan here? Well, management argues that they've built a really resilient business model, one that's designed to avoid all the risks that are tripping up everyone else in the volatile solar installation game. Their whole strategy really boils down to three main pillars. First, they go shopping for deals, buying up existing solar portfolios that are already generating cash, just like that NJR deal. Second, they plan to partner with builders to scoop up brand new systems, but, and this is key, without taking on the risk of actually installing them. And third, they've got their Spruce Pro business, which is basically a service where they get paid fees, a really nice capital-light revenue stream. And if you want to know the one thing that guides all of these decisions, well, the CEO, Chris Hayes, couldn't have been more clear. He basically said it's all about one thing and one thing only, getting to positive free cash flow fast. That's their North Star. That's the whole game. Okay, so if the operations are humming along and the strategy makes sense, we have to come back to our main question. Why did the market dump the stock on what looked like great news? Let's try to solve this disconnect and look at the concerns that are clearly weighing on investors' minds. It seems to come down to a few key worries. First, even with that strong operating EBITDA, the company still posted an official GAAP loss of 17 cents per share. Now, for a lot of investors, that's the real bottom line because it includes things like depreciation. Second, let's be real, this is a microcap stock, and with that comes a ton of volatility and not a lot of trading volume. And finally, people are wondering, okay, that big acquisition was great, but can you do it again? Is this growth sustainable? So, with all that context, it's time to make the call. Let's lay out our thesis for what you should expect from Spruce Power going forward. So, when you put it all together, where does Spruce Power go from here? Is this a misunderstood gem that the market is just overlooking? Or is it a classic value trap waiting to spring on you? Let's look at the two sides of the coin. The bull case is pretty simple. Management is absolutely nailing it on cost controls, their M&A strategy is clearly working, and they have a clear path to generating cash, with over $90 million in the bank to get them there. But the bear case is just as clear. The company is still losing money on paper, finding that next big deal is a huge question mark, and frankly, the stock is just too small and thinly traded for a lot of big investors to even consider. So here it is, our next call.
We fully expect management to keep up the great work and deliver another strong quarter operationally. The cost savings seem real. However, we think the stock is probably going to be stuck in neutral, just trading sideways. The market has sent a crystal clear message. It wants to see black ink. Until Spruce can turn that operational strength into an actual on-paper profit, the stock is going to have a really hard time breaking out.
And for that reason, we're initiating our coverage with a market perform rating. Look, the operational excellence here means we just can't be bearish on the company. But the market skepticism and that big hurdle of GAAP profitability mean we can't be outright bullish either. Spruce is what we call a show-me story. And for now, the market is sitting back with its arms crossed, waiting to be shown.
And as always, please remember, this is not financial advice.